Hello, everyone, and welcome to this short video on remuneration trends in the life sciences sector. I'm Carol LePage. I'm a tax partner here at BDO, and I'm joined by David Ellis, who is a remuneration partner and a specialist in all things reward. He and I are going to have a conversation just around how remuneration is looking within the life sciences sector in particular, building on the trends and themes from the Life Sciences Live webinar that we ran in the first part of last year. So David, hello.
Hello, thanks for having me, Carol. It's really good to be here.
Great. So I think last time when we had our Life Sciences Live webinar, it was very much we're coming out of COVID, things been a bit unsettled, and that was coming through in some of the trends that we were seeing. If we roll forward 12, 15 months since that conversation, what sort of things have you seen since then in the sector?
Well, so you're absolutely right. We looked at this just over a year ago, I suppose, and there was just volatility out there. So certain people were being paid a lot more, mostly because incentives were vesting that had been granted at a relatively low base and had then vested by, sort of 2023. We were seeing those clear differences between US and UK pay, and therefore companies with a footprint in both camps tended to pay more than ones with just a UK base. And obviously we were seeing some real differences in reward depending upon the stage of development that a drug may have in the context of it being taken to market. I mean, I guess what we can see now, and of course it covers a whole world of areas in the context of reward. I mean, there are many different facets to it, but let's just start with one so that you can kind of see how the world has moved on. So if I take base pay as an example, what we are seeing, I guess, in 2024 is that the setting of budgets for pay specifically has really given rise or highlighted, I suppose, that push-pull between organizations desperately trying to cut cost, but also desperately trying to keep key talent. And you might say that's an impossible dynamic, but I think what it's shown us is it has meant that salary increases are a little down on what you might expect to see, not by massives, a percent here or there, nothing that goes crazy in that context, but it's really causing some pressure on both organizations who don't have a footprint in major biotechnology hubs, for example, and for organizations who are cash constrained, I guess, who can't simply throw money at the problem. So that's a really interesting example, I think, where our post-pandemic world has moved into something which is commercially a bit sharper and a bit more realistic, possibly.
Yeah, and it's difficult, isn't it? Because with inflationary pressures that we've had for more than just the last sort of 12, 15 months, but certainly continuing through that period, it's so important, isn't it, that people feel that they're paid enough, and that cash bit has to increase accordingly. And life sciences businesses, particularly in the early stage, are in that really cash constrained bucket as well. So presumably they're needing to be even smarter about how they're using the kind of non-cash piece and the performance-based bit of the package for that.
Yes, I mean, I think that's true. So if we take bonus practice, for example, bonuses across all walks of life have a slightly magical element to them in the sense that the metrics pursuant to which payouts are based tend to be remarkably resilient to the ups and downs of commercial life out there. But I think that what we again are seeing in the sector is just something that shows that those payouts are coming down slightly. Now, you might say, well, slightly is not much, but they didn't come down that much in the midst of a pandemic, to be honest, to be completely obvious. So, I mean, you wouldn't expect them to come down massively, but if they came down 10% overall, that would be quite a big deal, and make a big difference to people. And consequently, I guess what that's showing us is some of the pressures around fundraising, cash flow, progress along a pipeline in development of a drug, for example. They're all taking their toll here. And there are many ways of organizations responding to this. Of course, most would simply go, you've not hit the metrics for paying less. Lots have looked at this and said that is the case and we're not changing that. But we have a piece of your bonus which is triggered by you hitting personal performance metrics, and lo and behold, personal performance has remained pretty high across the piece to somewhat offset that downplay or downturn in economic outcome from a variable pay perspective. So quite interesting there, I think, if you look at it from a bonus perspective specifically.
Yeah, yeah, it does sound interesting. And people are very sort of wedded to getting a bonus, aren't they? It's quite an important thing for people, particularly at the moment. And that, if you're getting a bonus in cash as well, that can be quite powerful. If we're looking more at the sort of longer term pay piece, I think when we spoke back in May last year, we were looking at the sort of particularly the AIM sort of metrics as an indicator more than anything. And it did look like life sciences businesses and non-life sciences businesses, pretty much it was a similar split between sort of the cash bit of the package and the long-term incentives and things. Have we seen any shift in that, particularly given, say, the sort of way share prices have been performing and things?
So we've seen a lot of volatility in the sector, and I think what that does, I mean, it's not entirely sector specific, but it's very prevalent in the sector, is to create pressure on an organization to move away from awarding equity on the premise that here is equity today worth X, and you can have it at a period of time in the future if you do Y, towards a model which says, here is some equity, we expect it to be worth this much in the future. So much more focused on the expected value of an award rather than its value today. I mean, some of that is because share prices are depressed today and it's not such an exciting story. But much more importantly, of course, where your share price has gone down, you run the risk, or employees have the opportunity of being awarded much higher percentages of an organization because the value today is significantly lower. So if you think about how organizations are looking at equity these days, it's focusing on what they expect it might be worth in the future and using that to calibrate how much to award, keeping a very close eye on the percentage in aggregate, which is in an employee's hands rather than in the hands of investors, and to look of all of the equity that's available for employees, how much you are using every year. And you put those three pieces together, you probably got a closer view of how people are approaching grants than I've been given a grant today worth $500,000. That's not so much an issue in the sector these days. It's much more looked at whole of company value and the proportion that's been awarded. I guess there's a couple of other things to add in the long-term space. There is, where share prices are depressed, much more commonplace would be one-off retention opportunities for people to keep them locked in. It's quite hard to reprice whole great tranches of equity awards. So a one-off retention deal to a very key talent is an easier way of fixing that problem. And possibly where you've got again, things which have gone underwater, a greater use of restricted stock. So with an inherent value on grant rather than that which needs to get out of the money before it's worth something. All being equal, I guess it simply keeps pointing to the fact that increasingly the listed company world, or using your IPO as your exit opportunity, is still second choice to PE, to be perfectly honest. And I'm not suggesting that's good, bad, right or wrong. I'm simply saying that much of the practice, therefore, we see around equity is coming from that sector rather than our traditional listed sector. And we should expect that to continue.
Yeah, and that makes sense, because very much that sort of lens on what will the shares be worth in future is very much a private company lens in a way, isn't it? That's what you see in a PE environment. So that does make a lot of sense. When we caught up last time, we were talking a bit about location as well, and that kind of dynamic where people want the flexibility to be able to work from anywhere, and also what that means almost for regional dynamics as well. Have you seen any evolution in that location space?
So a bit, I mean, it used to be and it still is in some organizations, I mean, some noticeably very, very large, that in this sector, working in a fixed place at an office or at a lab was very, very much the norm. And one would have expected that to carry on. I mean, I think what we're seeing is the pressure to create additional flexibility or maintain flexibility is absolutely still there and probably still peaking, if I'm being honest, which is where people can't find that flexibility. Really, it's not a proposition that they're as interested in. So for a cash constrained company, if they can be flexible, it provides them with competitive advantage because ultimately it's free. I mean, that's a massively important factor to this jigsaw, which is if you can create an employment proposition for a group of people as cost competitively as you possibly could, then you end up in a world where you are mixing it up with some pretty big players because you can do it in a different way.
Yeah, yeah, that does make sense. And certainly in the life sciences sector, finding the right talent as well can be really difficult. So if you kind of add the two together, actually the ability to find the right talent and give them flexibility, gives you quite a powerful proposition, hopefully.
I think so. I think so. And it points to a whole host of other things, I guess, in the scheme of things. I mean, ultimately, yes, where you work, there are some pieces to do with how attractive can you make the workplace when you do go there. There are some pieces to do with, I mean, ultimately, what career opportunity or progression or experience can you provide people? It's all super important in creating, yourself as an employer of choice. Unfortunately, it doesn't change the fact that sectorally people are still very interested in this is the base pay I will be receiving and this is the variable package, which makes it an exciting proposition for me. And so we shouldn't lose sight of that as our main hygiene factor. But there's plenty more an employer can do to make their proposition as compelling as possible, notwithstanding the fact that cash is not as readily available as they would perhaps like.
That sounds like a very good message to end on. So thank you, David. That was really an interesting conversation. And if anybody wants to hear more, please do check out our Life Sciences Live webinar from last year. It's linked along with this video. So please do take a look and get in touch if you have any questions.